Okay, welcome to the August 15th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a bit about crop conditions, of course, the changes USDA made to its balance sheet projections in last week's WASDE report. And then we're going to talk about the upcoming RIN generation data from the EPA's EMTS system for July and the spread between D4 and D6. Before we get started, just a couple of little housekeeping items. One, I'll be out next week, and so Joao will be doing the webinar, and he's going to talk a bit about what happened last year in South American production and what our early expectations are for the coming year. And then the following week is Labor Day weekend. I would be gone anyway, but we won't have a webinar that week, the first week of September. So this will be the last time you'll see me for a couple of weeks. All right. So we are in the midst of the most critical period for the soybean crop yield. USDA reported that 78% of the US crop was setting pods. And so this is the time when rainfall really counts. And because over the last several years, farmers have tended to plant soybeans a little bit earlier, typically we used to think of sort of mid-August to mid-September as the critical period for pod filling. And now I would say that might be shaded a week or so kind of forward. So maybe the second week of August to the first week in September. I honestly thought it would be a little bit more, but when I looked at the pod setting data, it's really not that far ahead of the 5-year average. And they've been doing this for at least the last 2 years and probably the last 3 years, planting soybeans a little bit earlier. So maybe that shaded the 5-year average a bit, but either way, this is the time where rainfall really matters. And this chart shows the deviation from normal rainfall over the last month. And you can also look at rain that happened within the last 7 days and within the last 2 weeks. Generally, the pattern remains the same. Mostly the driest areas are that area from northeast Iowa up to the eastern part of North Dakota. And if we look at the forecast maps, the next 2 weeks do not suggest that there's going to be a lot of rain in those areas or really most areas in the Western Corn Belt. Now, the areas that got a lot of the rain here over the past month, all of this is, they should be relatively well set. If some of the areas were really dry, and so maybe the rain didn't really recharge soil moisture, and maybe the crops will need follow-on rains to really meet yield potential. But in Nebraska, a lot of the farmland is irrigated anyway, and Missouri, and as you get sort of further to the southeast, those are where the crops are actually rated best in terms of crop condition ratings. And then if you get over into the Eastern Corn Belt, there has been sufficient rain recently that really shouldn't be a problem. So really, we're just concerned about, I guess, that area from Iowa up to North Dakota. However, that's a big producing area. Iowa, southern Minnesota, and then the Dakotas are one of the largest producing regions in the country. And so while generally conditions have improved and USDA's August yield estimate was not as bad as it could have been, there probably will remain some concern about crops in those areas. Now, I still firmly believe that after the US crop is made, or at least the market has a really good sense of what it thinks the crop is going to be, and it changes its focus to the South American crop, that the expectations for a big increase in production there will likely pressure soybean and soybean oil futures anyway. And we'll see if the crop turns out to be all that's expected. But I say that to say that they're in for soybeans, and I know we most people here are more concerned about vegetable oils than soybeans. For soybeans, the cash markets are probably going to start to look a lot like the vegetable oil markets, where the US price is disconnected from the world price and basis levels are significantly higher in the US, to the point where USDA added 10 million bushels of imports for both 22-23 and 23-24. 10 million bushels isn't a lot, but I think in looking at the balance sheet in total, kind of what it says is that based on the reduction in the crop size, there were relatively limited options to offset that decrease on the demand side of the soybean balance sheet. So we've already talked about how I think just generally crush is going to be favored over exports. The part that I kind of missed was despite the fact that it looked like we were probably going to build soybean stocks in the US this year, with the cut in yield, stocks have fallen back down and are historically tight and are not substantially changed from 22-23 to 23-24. And so that 10 million bushels, while it's not a lot, it does reflect sort of that dynamic. And in some ways, I think that it is part of forecasting balance sheets is sort of like trying to figure out a puzzle. And okay, if I take a little bit here and add a little bit here, and then everything works out. And I think on some level that increase in US imports is a bit of that USDA understands that ending stocks are relatively tight. They didn't really want to take them down further. It looks like probably there was a low boost in demand in the old crop, and they carried that through to the new crop because in part expectations for basis to remain strong in the new crop year should be rising given the carry out and the strength of demand, particularly crushing demand. Outside of that, on the soybean balance sheet, USDA didn't really make any other changes that weren't really expected. That was a fair amount, but they left their crush forecast alone for both old crop and new crop. They cut their export forecast, not quite as far as their new prediction is not quite as low as ours, but it's in that direction. And I think we are kind of in a spot here where we were with US soybean exports where we were with US soybean exports the last couple of years before we really fell off the cliff this year. So I think they and I and probably a lot of analysts are still trying to figure out exactly what the right level for soybean exports are. And then ending stocks have fallen below 300 million bushels, which was a little not, I guess, super surprising. I didn't have a good sense of where the yield was going to end up. And so, but if you had told me where the yield was going to be, I probably would have said ending stocks would be somewhere close to where USDA is, maybe a little bit higher given our expectation that exports won't be everything that USDA thinks they're going to be. And so from a sort of a theme standpoint, the changes USDA made sort of fit in with what we've been talking about. This week, crop condition ratings jumped sharply up to 59 from 54 and now back above sort of the last couple of years. You can see that the move has been really not aligned with the typical seasonal pattern, which typically features sort of a decrease as the crop matures. This year's crop started out so dry that it's not surprising that conditions are improving. The key question is going to be that how much of an impact does that Iowa crop, and then to a little bit lesser degree the Minnesota crop, but then certainly a fair amount of the South Dakota crop. How much impact does that have on the yield? And USDA cut their yield forecast by 1.1 bushels per acre from 52 down to 50.9. Interestingly, so I talked a little bit about how we do our yield forecast, and it's based in part on the changes from in the condition ratings from month to month during the first week when USDA is doing their surveys. But because this year was a little bit different than a lot of years, I did something different as well to look at the potential changes in yield, which was compare the change from July to August with just the level of the condition ratings. And that actually suggested a 1.1 bushel cut, which is what USDA did. So the change makes sense. And at 50.9, I think that I can make an argument that that may be USDA's lowest yield prediction of the growing season. And I can also make an estimate that, or an argument that they will cut their yield forecast going forward. It really depends on how much of the next 2 weeks forecast verifies and whether we get more rain or less rain than predicted. You can see that in terms of, again, setting pods, we're a little bit ahead of where we are. We're certainly not setting records this year, but the real point of this slide is to say that, you know, starting last week or the week before, rainfall is going to be really, really important. And if we get timely rain across the entire Corn Belt, then I think that it's easy to say that the yield probably, the US yield probably comes up. If the rain is as expected and focused on the Eastern Corn Belt, I think that probably this could be kind of the peak in condition ratings. Maybe you get one more week of up 1% or unchanged or something like that. But then you get declining condition ratings in through the end of the year, or at least the next 3 or 4 weeks. And that swing will be really, really important, because what USDA did in the August report is essentially take their ending stocks down to a level that it's going to be hard to adjust substantially lower. So if they cut another 100 million bushels out of the crop, they can't really take a huge chunk of that out of ending stocks. Now they could take 50 or 60 million bushels out of ending stocks, but then they would print an ending stocks number that was relatively close to 200 million bushels. And I don't think that that's necessarily where they want to go. It hasn't. They've had an opportunity over the last couple of years to print ending stocks numbers that are that low, and I think they did a little bit, but that number is a very sensitive number for the market, and getting down towards the pipeline level for the U.S. carryout is something that that I think USDA takes very seriously, again, because so many people listen to USDA. Either way, like I said, the rest of the crop will probably get into pod filling over the next week or two, and then it will just literally be looking at the rainfall totals every day and trying to figure out how much of the crop area got covered. So in terms of the changes that USDA made to their soybean oil balance sheet, they basically raised their old crop yield a little bit, and that raised their production forecast. They also raised their feedstock demand forecast, in part because of the strong feedstock demand that we talked about in May from the last report. And then they raised food and domestic non-biofuel usage as well. The increase in domestic non-biofuel usage is a little surprising. Not that I think that it has slowed down dramatically or anything like that, but it already looked relatively hard to get to USDA's number, or a little bit harder. I mean, they're not that far apart from where we are. But given the given where the current market is, it doesn't suggest that domestic non-biofuel demand is about to go on a tear. Now, I don't necessarily think that it's about to fall off a cliff either. In fact, kind of what I think is that everybody's kind of waiting around to see what happens with basis before they really start to extend coverage past Q3. And so I think that right now demand may look a little weaker than it actually is. If USDA's forecast is correct and verifies, I think that that there's some chance that basis levels, which have come down just slightly over the last week, may start to stabilize and then may start to go higher into the end of the year. We'll see, and a lot of that strength will depend on the strength of the economy and non-biofuel demand and biofuel demand. But with biofuel margins rebounding, it doesn't look like there's an argument that demand is going to slow on that side. And if you add non-biofuel demand into that, then it paints a picture of relatively robust demand. And in that situation, of course, every market is unique in terms of basis, but in that situation, if demand is that strong, I have a hard time understanding how basis levels will continue to move lower. Doesn't mean they won't, but they could. And so those changes cut USDA's ending stocks slightly. They're still a bit above where we are, primarily because of the difference in our expectation for biofuel feedstock demand. By the way, if I hope that the lawnmower noise isn't too bad. It usually does not come on Tuesdays. If it is, I apologize. On their new crop, the only change on their new crop balance sheet, the only change they made was a 50 million pound reduction in their new crop export forecast. That seems like it's kind of obvious. I mean, whether exports are going to be 300 or 400 million pounds, that's not going to make a huge difference in the U.S. balance sheet. In the 50 million bushel or the 50 million pound reduction was likely as much a reaction to the lower beginning stocks than it was something that USDA has changed in their trade matrix, and these 50 million pounds just aren't needed anymore. In canola, USDA actually made quite a few changes to their canola oil balance sheet. And the first one is obviously a cut in production. It's closer to the number that we were expecting. So I don't have any real issue with that. They raised their old crop imports again closer to the number that we were expecting. Really, the changes that they made, other than the increase in their exports, all kind of aligned with where we are. And I would say that even the export number, they were below us, and now they're above us, and it may be that we need to raise ours a little bit. But there's nothing that USDA did to their balance sheets in the August WASDE that makes me think that I disagree with. And similarly on the new crop, the only thing that I question a little bit is just the reduction in non-biofuel demand. Like I've said before, we haven't really seen a slowdown in non-biofuel demand across most of the feedstocks, and canola oil is supposed to be the substitute in the food industry for soybean oil. So that one is a little bit counterintuitive. However, given what we talked about recently with the growing portion of US shipments, at least in 22-23, that are coming from non-biofuel or coming from countries other than Canada. And the likelihood that those imports are going to be sustained over a long period, I could see kind of reducing non-biofuel as a response to the idea that maybe next year imports from Australia and Europe aren't quite going to be what they were this year. And it's something that frankly in our balance sheets, it's probably the one area, US imports, that I'm most worried about, and it's just because we've built in such a big gap between Canadian shipments and US imports, and I just don't know that additional supply is sustainable. It may be sustainable, and I certainly hope that it is, but I think sort of the proof is in the pudding on that one, and we'll kind of see. The increase in biofuel feedstock use, I think, like I said last week, if they're going to raise the old crop up closer to where it should be, they're going to need to raise their new crop too. So that one makes a lot of sense. And the one thing that I'll say about just the balance sheet in general is that there were a couple of months there where USDA's ending stocks number had started to creep up back towards what I would call sort of the long-term average. And that obviously came down pretty significantly. We had started to creep up a little bit too, but we lowered it in part because of the shift that we made in canola biofuel demand. And if that is actually where demand is going to, or if that's sort of the equilibrium for canola biofuel feedstock demand, then I would argue that it's probably the new long-term average is probably going to be lower than it has been in the past. In this sort of 150 to 200 million pound range is kind of where we're going to be going forward. All right, so let's talk a bit about what's going on with profitability. You can see just for soybean oil that profitability dropped and then bounced up sharply in biodiesel production. And that was mainly driven by increases in energy prices. So if you look at the price of renewable diesel or biodiesel in the California market, both of those bounced back. Of course, crude oil prices rose, so renewable diesel and biodiesel prices across the country bounced. And that has helped profitability for soybean oil as a feedstock recover. And if we look a little bit more broadly, if we look at, this is renewable diesel, but you can see that margins generally have bounced on the recovery in energy prices. Renewable diesel has fallen, I think, just a little bit more over the last couple of months than biodiesel. Renewable diesel actually fell first because of a relatively larger decline in renewable diesel prices compared to biodiesel. And then because of our choices for feedstock mixes, the biodiesel feedstock mix tends to be more soybean oil focused, or doesn't tend to be as more soybean oil focused, and the renewable diesel is more fat and grease focused. And so this really kind of reflects more of the change in fat and grease feedstocks, or our profitability does. And that's where it looked like renewable diesel fell a little bit more, in part because of a larger decline in renewable diesel prices. And then that was because it fell earlier. That was the period when soybean oil prices were coming down a bit, and fat and grease prices kind of stayed the same, or maybe even moved up a little bit. So it's reduced profitability, but not nearly as much as we saw in biodiesel when you use soybean oil as a feedstock. Still, From this chart, you can see that margins are at the lower end of the recent range for most of the commodities. And so I think that this part isn't necessarily surprising. The key question is going to be how much will the continued expansion of renewable diesel pressure biodiesel margins? And several weeks ago, it looked like that was sort of finally starting to kick in. The bounce back suggests that those margins may be a little bit more robust than or it may be more difficult, I guess, to get biodiesel producers out of the market than by just simply taking margins down for a little bit. And I also think that with each passing sort of event like this, so we had one during the pandemic, and then we've had this one, the market goes down and then bounces back. All that does is essentially train biodiesel producers to expect the market to bounce back. And so the next time that margins fall, it will be less convincing to biodiesel producers that that's actually a long-term sustained change in margins and that they need to reduce capacity. Ultimately, it looks like biodiesel capacity should rationalize at some point. That said, I've had conversations with people that firmly believe that there will be little to no biodiesel capacity rationing at all, and that 10 years from now we'll have 2 billion gallons of biodiesel production each year. The one person that I've spoken with, or one of the people that I've spoken with that has that opinion, somebody I respect and somebody that knows a lot about the industry. And so I honestly, I wouldn't say it on here if I didn't think that there was some credence to what they're saying. It still seems like a relatively narrow path to get there, but each time margins fall down to a 30 or 40 cent a gallon loss and then bounce right back up, I get more and more convinced that that's probably actually what might happen. Now, again, I still think that it's probably the lower end of the probability, but biodiesel producers don't have a lot of good choices at the end if margins don't remain positive. And so that choice is a really hard one. And I would expect that I've kind of always thought that biodiesel would stick around longer than people thought. We're getting to the point where it's hard for me not to think that it's going to rationalize, but this is also the time when we should start to see at least a little bit of rationalization, at least a little bit of pressure on the margins. And yeah, we did have some pressure on the margins, but I think that was more a function of of a decline in energy prices broadly than we're overproducing biodiesel. And so biodiesel falls while the rest of energy prices are going up. And that's really what sort of needs to happen to get any kind of rationalization at all. And if that doesn't happen, then I think it will be very tough to get biodiesel producers out of business. And then a final look just across the feedstocks at biofuel or biodiesel profitability. You can see that while we look at soybean oil on a weekly basis for our biodiesel margins, that the other commodities followed essentially the same pattern, and that the bulk of the recovery has been driven by a recovery in energy prices, as opposed to a big drop off in feedstock costs. Now, feedstock costs have stabilized and in some cases come down a little bit, and so they did contribute, but the bulk of that move higher is really due to feedstock or to energy prices. The only other thing I would note is that now all of the feedstocks are back to positive, are profitable again, and so it means that perhaps the stronger than expected soybean oil use that we saw in may not continue in the same way that it was then. We assume a lot more soybean oil gets used in production than typically happens. So typically we assume that in renewable diesel production anyway, soybean oil is mid 40s or a little bit higher, 40%, 40 to 45% of the total feedstock mix, maybe a little higher. I guess I should say 45 to 50%. And the reality is it's been coming in between 40 and 45%. And in May, that bumped up a little bit and we got stronger than expected usage. With all of the commodities back to profitability, that seems less likely to happen, I guess, in the future. There's in my spreadsheets, I have a little area where I compare the feedstocks, and it's kind of an automated thing that comes up and says, yes, you should substitute this feedstock for this feedstock this week. And while I know it's not that easy, it does provide some indication of where feedstock demand might be going. And for the most part, there haven't been many times where substituting feedstocks for soybean oil substituting soybean oil for other feedstocks has made a lot of sense. However, over the past couple of months, if you looked at the soybean oil tallow comparison, and assuming that I got all of the formula correct, the prices would have suggested that you substitute soybean oil for tallow. So the only thing that I think that we can draw out of what's happened recently, other than the fact that I think it's going to be more difficult to get biodiesel capacity to move lower, is that maize soybean oil usage, maize soybean oil feedstock demand may have been a bit of an anomaly, and we may go back down below 1 billion pounds a month here in the short term. In the longer term, I think it's a given that we get above 1 billion pounds and get to sort of a 50-50 split between non-biofuel domestic usage and biofuel feedstock usage. But in the short term, and we'll kind of see, but I have a feeling that May might have been a little bit of an outlier. All right, so what does that mean for production? We've got production in July on, I guess I should have started with, on Thursday, we'll get data from the EMTS. The EPA will publish data for July. And so we've got production in July down a bit for biodiesel, in part because of the sharp decline in margins. However, the feedstock that was used to produce biodiesel in July was not, in all likelihood, the vast majority of it was not purchased in July. So that production, while the margin calculation certainly should have some impact on production, still the margin calculation may not be exactly the same for biodiesel producers as we print, because our cost assumes that they buy it on the day that they use it, essentially, and that's not kind of reality. So it may be that a lot of that feedstock was purchased before prices rallied a bit and was less expensive than what we saw in July, and so margins may not have been quite as bad as we're estimating for each individual facility. And so production could be a little bit higher than we expect. I still need to adjust our January 24 and 24 forecast more broadly. I think that what I'm going to do probably is have production come down a little bit more like we've seen over the last couple of years. Kind of, if you look at the chart, there's a trend line that moves modestly lower across the chart, and so I probably will reduce it by about that amount. And then as we get into 2024, we're going to need to make some decisions about what we think for 2025. The expectations for what happens to soybean oil demand as we switch to the IRA vary from we're never going to use soybean oil again to the industry standard CI scoring model is going to shift a little bit, and that shift will bring soybean CI scores or soybean oil CI scores down below the 50 threshold for receiving some of the IRA credit. Now, nothing is going to make it so that soybean oil CI score is close to UCO's score. So there still will be a bigger advantage to using fats and greases, but it's going to be really interesting to see it. And of course, we can't produce as much biofuel as we do without using soybean oil. So I tend to discount the people that say we're never going to use soybean oil again a little bit. The part about the CI scores and soybean oil staying at 45 to 50% of the total feedstock mix, that may be a little optimistic too. But it's going to be interesting. For renewable diesel production, this is still largely driven by the expansion in capacity. Not 100% sure what's going on with the margin line there. That shouldn't look like that, I don't think. I think I was calculating something under the bottom of where the chart was, and I may have copied the chart before I erased it. So apologies for that. We don't expect renewable diesel margins to plunge in January. Much like biodiesel, we kind of expect them to recover and stabilize a little bit lower than they have been, but certainly profitable, and we expect production to continue to grow with the expansion in renewable diesel capacity. Margins are still such that there's not really any good reason to expect that renewable diesel production would be dramatically different than what you would imply based on the capacity. We still have the question about capacity utilization rates, and there still are questions about how many RINs we are going to produce and whether we overproduce RINs, and if we overproduce RINs, does that make the market? All of those things are still open questions. I tend to not think that is going to happen, but again, there are people with different opinions, and that's what makes a market. All right, so just for a preview of what our forecast looks like in terms of feedstock demand, we don't have everything on here, but if you look at soybean oil, we do have it coming down. We didn't really change our projections after we got the May data, in part because of the idea that the May data may have been an outlier, and then margins were moving a little bit lower. So we've got it down a little bit, but I think that over the next month or two, we should get a better sense of where that number is, and when we really will kind of breach 1 billion pounds a month and keep at that level going forward. Not 100% sure we're there yet, but if we get 1 billion pounds of demand when the EIA releases their monthly report at the end of this month, and then they repeat that again next month, then I won't have much choice but to admit that that soybean oil use in biofuel feed or in biofuel production will be 1 billion pounds per month. The other thing that I would kind of point out and note here is if you looked across the feedstocks in May, almost every one, now there's some like poultry fat that have just kind of fallen a bit out of favor, in usage, which wasn't that big to begin with, has been cut about in half or 2/3. But other than those kind of exceptions, and poultry fat was one, choice white grease may have been the other, but I think even choice white grease set a record for usage in May, and by a fair amount. It's not like, UCO and yellow grease went from 592 to 600. It went to 650. So it's almost 10% above the old record. Same with soybean oil. We jumped from 950 to 1.15 basically. So I think that you have to take the May demand with a bit of a grain of salt, and maybe that is in part why we're seeing a little bit of weakness in basis right now. Is the market got charged up on the May data and there hasn't really been some follow through. I don't think that that's really kind of what's going on, but it could be. Strong demand in 1 month tends to set expectations kind of going forward. But I think May have been, again, I think may have been a bit of an outlier, but we'll see what happens with first the production data for July, and then ultimately with the feedstock data when the EIA releases it at the end of October. All right, so let's talk a bit about RIN prices and the historically narrow spread between the D4 and D6. Last week, we published an article in the biodiesel section, which asked several questions, one of which was, can D4 trade below D6? I talked to Bob Lane. Many of you will know Bob and know that Bob knows as much about these markets as anybody, and certainly more than I do. And I asked him, is there a regulation or something that prevents the D6 from trading above the D4? And he said, no, but it never will, because essentially the D4 is more useful. It can fill more areas in the mandate, and because of that, it will always carry a premium. I don't disagree with that. And I think that generally that makes sense and certainly explains why D4 is traded at a premium to D6. However, the spread is narrowed to essentially zero now. It's 50 cents right now is the spread that we're reporting. Over the last month or two, it has effectively been zero some days. And if the spread can fall to zero and there's no regulation that requires the D4 to trade at a premium to D6, it does seem like there's an opportunity, sort of George Soros style, to come sit on the D4 and see if it'll break. And if it does break, does it carry the D6 down with it? Now, the reason the spread is so narrow is because ethanol production is not going to meet the ethanol mandate. So if we look at the difference between our expectation for ethanol supply, which is the vast majority of it is domestic production, relative to the mandate, we figure that there's about a 780 million gallon shortfall this year. That's down from 835 million gallons last year. Last year, the spread didn't trade to zero. It got narrower as we went through the year, but I don't think it ever got quite to zero in 2022. And it was fairly wide at some points. That's kind of my first open question. If the ethanol gap is really driving the spread, and I think that it is, I should have prefaced this whole conversation with, while I want to talk about this and sort of bring this up, please don't take this as I'm saying, oh my God, the D4 is going to trade below the D6. It's just something that I kind of got into and I found interesting. And then I started to think, if there really isn't a reason, if there's not something that's preventing it, other than it's more useful to fulfill mandates, why can't it go under? And so I thought I would bring it up on this call, and maybe people will think that it's not productive to talk about, but I got to fill an hour. Anyway, so if somebody came and sat on the D4 and just sold it, or conversely, if somebody came and just bought the D6 and just bought it and bought it and bought it and bought it. I understand that the market would probably move, and whatever change happened in D6, D4 would probably continue to float above it. But there has to be a point where if somebody just sheerly out of financial interest, somebody just figured that the D6 should go up and they want to buy $400 million of D6 RINs. I just don't necessarily believe that that wouldn't cause the price to trade at a premium to D4. Again, maybe it would, it probably would. But I think, again, if you asked people before Soros sort of broke the Bank of England, if a single hedge fund can trade against a central bank in the currency markets and break that bank, or break the currency out of the range that it's supposed to be trading in, then it can happen in other financial markets like this one. Now, the two situations aren't exactly the same, and a lot of the transactions in the RIN marketplace are economically driven as opposed to speculatively driven, and that does tend to ground the spread in its historical relationship. So that does tend to make it more difficult for the D6 to trade above the D4. But I don't think that it's entirely 100% impossible. It might be, it may never, ever, ever trade there. But if I don't talk about it when the spread is essentially zero, then I will never get a chance to talk about it. The other reason that and really the main reason that I wanted to talk about this is because we use, to predict D4 prices, we essentially use the HOBO spread, or the spread between soybean oil and heating oil. And then we use the D6 value to forecast D4 prices. To forecast D6, we look at the spread between the value of ethanol and the cost of the feedstock, so another profitability indicator. And then we look at net RIN generation. It's not a great, the D6 model is not fantastic, but there's not anything as clear that could be sort of another input as sort of net RIN generation. And so because of this, we can kind of look at when we expect profitability for ethanol production to move higher or lower, and we can compare that against our expectations for profitability of biomass-based diesel production, or advanced biofuel production, I guess. And if you look right now, the two profitability estimates or predictions sort of move in opposite directions. So the profitability for ethanol tends to move lower from here through next spring, and the profitability for biomass-based diesel tends to move higher. As a result, the D4 model would like to predict prices significantly below where the D6 is trading, or where the D6 model is predicting prices. I don't set them that way because I believe that D4 probably will never trade below D6. But if I just left it to the model would suggest that the D4 would trade at a 20% discount to D6 or more by the time we get to next spring. And so that's really what brought this question up. But a bit of it was just pure frustration that I was having to adjust the models from something they were predicting, just because this is kind of the way that the market works. And while that's a fine reason, it's tough to model mathematically, other than just to say, okay, well, it can never fall below D6. So whatever the D6 price is, that's what you're going to set D4 at. That's where we are right now. And again, it was something that I thought was just at least worth a conversation while the spread is this tight. I still wonder a little bit, and it still bugs me a little bit, that if you look at last year's ethanol gap, it was larger. The spread didn't tighten up as much as it has now. This year's ethanol gap is something that is well known. And oops, if we look at biomass-based diesel production against the entire mandate, the advanced or the biomass-based diesel mandate, the gap in the advanced mandate, and the ethanol gap, it still looks like, or we expect anyway, that the industry is going to overproduce relative to that mandate. So the market should know that the ethanol gap is there. Okay, fair enough. It's narrowed since last year. Maybe it's a cumulative effect. I don't understand why that would be, but maybe it's a cumulative effect. So last year the spread narrowed. This year it narrows a little bit more, even though the ethanol gap has fallen. Even all that though, our analysis suggests that we're not going to have a problem generating enough RINs to meet all of the mandates. And in fact, one of the concerns is that we generate too many RINs and we're going to break the RIN market just on supply. I don't necessarily think that's going to happen either, but that's an argument that people have made. And so the market should understand the ethanol gap is here. Biomass-based diesel is going to step in and fill the production. And I understand that the effect of D4 filling the gaps in production is exactly what is making that spread narrow. And so maybe it is just that, you know, 1 year you have a bigger ethanol gap, but the industry isn't quite as sure that biomass-based diesel production is going to be needed to step in. I don't know why, but let's just go with that. And then the next year, you have essentially the same situation. The ethanol gap has shrunk a little bit. Biomass-based diesel production is moving up. And so maybe it's that. Maybe it's the switch from the 314 million gallon shortfall relative to all of the implied mandates and the 990 million gallon overproduction. Maybe that's what makes the difference between last year and this year in the spread. And if that's the case, then okay, this probably is the maximum pressure you can put on the spread. And again, probably shouldn't trade D4, shouldn't trade at a discount to D6. It's one of those little, I guess in the end, it's one of those little interesting things that I think as an analyst, you generally are a little curious about the things that you cover at the least, hopefully. And every once in a while you run across something like this that just is a bit of an anomaly and it kind of bugs you. And as you dig into it, you do a couple of things. You learn a lot more about how the markets that you're covering work and how you think about how they work. And sometimes you discover either A, that one of your assumptions or the way that you're thinking about something is wrong, which is always helpful. Or B, you may learn something not entirely related to exactly what you're looking into, but maybe something that's sort of adjacent to what you're looking into. I don't know that either of those are going to happen in this case, and I don't know that the last 10 minutes or however long has made anybody smarter, but I wasn't going to not talk about it, especially after I wrote about it. I didn't want people just to read that and not have a broader context than the questions that I asked in the article. All right, that is it. And thankfully we have some questions. Always appreciate that. Do you know the split of imports of soybean oil, as in how much is going to biofuel use and how much is going into food use? The question stems from the arbitrage that can happen from Argentina to the US without needing EPA certified soybeans. What is stopping much more imports to displace US soybean oil used in food? This is a really good question. So we talked a couple of weeks ago about the spread between prices at the Gulf and in Argentina, and why that wouldn't necessarily lead to a lot more imports in the short term. And the gist of my argument was basically that end users have relationships with their counterparts, and while it's not unheard of that those relationships might change from time to time, it is a bit of a process to change that relationship. It's a bit of a process to change that relationship if you want to change to another domestic supplier. If you want to change to a supplier that's out of the country and import soybean oil, not impossible by any stretch of the imagination, but you're going to, if you do that, your domestic supplier probably not going to be super happy. And you are probably making more of a commitment than Econ 101 would suggest. Econ 101 would suggest that when the arbitrage was positive by a penny, you just do it. That's not really how the world works. And so the end of my argument was really that given where the spread is now, the economic incentive is too great for people not to start doing this. However, given the structure of the industry and those relationships, I think it's something that, in the same way that negative margins are going to have to convince biodiesel producers to reduce capacity, and they're going to need to do that by going substantially negative, staying substantially negative for a long enough period of time that biodiesel producers are absolutely convinced that the industry is never coming back. Nobody's ever going to make another penny producing biodiesel. You almost have to have the same with the spread between the Gulf and Argentina. So the spread is going to need to be, or the arbitrage is going to need to be positive for long enough that it convinces end users that it is the new equilibrium, which it very likely is to some degree, maybe not to the extent that we saw a couple of weeks ago, but given that the US market is now essentially a domestic market, its price is going to be much more a function of whatever's going on in the domestic market than it is with whatever's going on in the world market. And because of, so if that is all true, and that large gap between the Gulf and Argentina persists, then I think you'll start to see more switching. Over the last couple of years, there's been a gap in our expectation for feedstock demand versus feedstock supply in the US. I've taken several different approaches to sort of solving and filling in that gap. What I started with initially was just plopping it onto soybean oil imports. And for a bit, I kind of even argued that I think at some point we're going to have to increase soybean oil imports pretty dramatically. I kind of changed the way that I thought about that then, and thought it's going to be really hard to get US soybean, for the US to import 5 billion pounds of soybean oil a year. I just don't know that I see that happening, not at least in the short term. If we, 10 years down the road, we slowly build up imports, I can buy that. Then I went to using canola oil as basically the balancing feedstock after the approval of the pathway for renewable diesel. And with canola oil, I can make the argument that, yeah, we're going to get most of it from Canada, but we're also going to get some from Australia, excuse me, and get some from New Zealand and in Europe. And that is at least semi-plausible. And so I think that for US imports to really grow, you would probably need to, on some level, remove the tariff. That would probably convince people that whatever the gap was, it was going to be significant enough that it's worth shifting your supplier from a domestic supplier to a foreign supplier importing your soybean oil. And that it may happen slowly over time. However, there are other alternatives for feedstocks that can mitigate the need for huge US soybean oil imports. And I just think, excuse me, I just think that the US is used to exporting ag products. Not that we don't import any, and not that we never would import large volumes of any ag products. We do it all the time. We do it champagne. If you eat Parmesan cheese, that's another ag import. And so it's not impossible, but with base commodities, we've been much more used to shipping out than taking in. And I think that the incentive is going to have to be there for a while to get people to really switch. The other part of your question that I'm not sure that I maybe understand, where you say the arbitrage can happen from Argentina to the US without needing EPA cert. Oh, never mind. I see. You're talking about food. Yep. They don't need the EPA certification. The EPA certification is an issue. It's not an issue that would really stop anybody. I don't think. I've done some work on it. There's some paperwork and there's a bit of a premium, but it's not impossible. And in fact, it doesn't seem like it is something that is a huge deal. I would assume that most of the imports will go into the biofuel industry as opposed to the food industry, in part because while soybean oil is generally soybean oil, there are differences in the soybean oil that is produced in Brazil and the soybean oil that's produced in the US. And there should be differences in Argentina too. I'm more familiar with the Brazilian differences, and so that's why I bring them up. And so for a company that's worried about the color and the taste and all of that kind of stuff, and that's the food industry, switching again to a foreign to imports as opposed to a domestic supplier just becomes that little bit harder. Now, again, I'm not trying to say that it could never happen, but I think if you have an expectation that this is something that's going to rapidly grow in the short term, I don't think that that's what is going to happen. I've asked a lot of people about this, and most people's response was something along the lines of, yeah, sure, everybody should do it. Are you going to do it? No. So that's kind of where you are. It looks great on paper, and in practice, I think it's a little bit more of a stretch. Why are you using D6 RINs to forecast D4 RINs? D6 RINs are typically capped, while D4 is more free to respond to market drivers. So shouldn't D4 be the main driver of all RINs? Yeah, on some level, I don't necessarily disagree with that argument. The reason that we use D6 RINs has probably, there are two reasons really, or two that I can think of off the top of my head. One is that we're interested in D4 RINs more than we're interested in D6 RINs, because this is a call that's focused on vegetable oils, but also on biofuel, biomass-based diesel. And so because of that, the D4 forecast was really sort of the end goal, and D6 is something that is good in predicting D4 because of that relationship that they have in sort of the limit on the D6 price, or the limit on, well, I guess the limit on the D6 price moving above D4 and D4 falling below D6. And so that's really why we use D6. I think the correlation there between the two prices, especially when there is the market is worried about the blend wall, that is the other reason we do it. So it's fairly well correlated to, or it's correlated to D4 on some level. And then we really wanted the D4 price forecast. So if this was an ethanol call, I don't know that I would use D4 to forecast D6, but we might, I guess, if it were turned around. I think generally most people use some form of D6 or maybe other credit price. It's mostly D6 and the hobo spread to forecast RIN prices. Though I don't think that that's something that is super unique to our model, and there aren't really a ton of other things that you can use to forecast prices. If you look at the correlations are not fantastic for a lot of things in RIN prices, essentially. So we end up using D6 and hobo is simple and effective, and that's kind of why we use it. I've noticed that the value of RINs is in cents per gallon, not cents per RIN. Given that biodiesel RINs generate 1.5 RINs per gallon and renewable generates 1.6 RINs per gallon, do you believe this proportion influences the ultimate RIN price? That is a really, really good question. So if you look at, again, sort of what correlates well with the D4 RIN price, there is basically feedstock cost is the thing that correlates most closely with D4 RIN prices. There is some question this year because we are expected to overproduce relative to the mandate, assuming that we get the expansion in renewable diesel production capacity that we expect, and we don't really get much of a decrease in biomass-based diesel or biodiesel production. Then we're probably in I guess I should say, in renewable diesel producers have capacity utilization that sort of makes sense from an economic perspective. And so I've gotten a lot of questions about the additional supply of RINs and what impact that's going to have on RIN prices. And from a purely logical standpoint, that makes all of the sense in the world. However, if you look at the supply and demand of RINs, the impact of the supply and demand is, as odd as it is not that great on RIN prices. So typically the RIN bank is, call it between 1.5 and 2.5 billion RINs that get carried over from year to year. And that big RIN bank and some characteristics of the RINs, I think, separate the effects of supply and demand in Econ 101 from RIN prices. So because RINs expire and you can only carry over so many of them, and your RVOs are renewed each year, there is a bit of separation from what sort of, again, Econ 101 would say the supply and demand, what impact Econ 101 would have on the the Econ 101 supply and demand impact on RIN prices, it gets a little bit separated. And so if you look at feedstock costs as opposed to supply and demand, you find that correlates relatively well. It's not something that seems to be happening right now. And so this is one time where if somebody came up to me and argued that the supply and demand of RINs was really driving RIN prices, it would be a little bit harder to argue this point, because right now RIN prices are essentially falling and feedstock costs are stable or moving a little bit higher generally. And so it could be that between now and the end of 2023, what we're going to see is lower RIN prices and higher feedstock cost. And if that happens, then I will the first call in 2024 apologize to everybody and say, look, I'm really sorry. I said it was only ever feedstock costs. That has been what it is historically. There does need to be a level where if you produce RINs, if we produced 3 billion additional RINs in 2023 over and above the mandates, or 5 billion or 10 billion, or just pick whatever number you want. But there is a point where that should break the price. That seems obvious, in supply and demand should be one of the laws at work, sort of like the physics laws work, except that it doesn't all the time. And this is one of the cases where it kind of doesn't. There is a level that that effect will take hold, but given what we expect overproduction to be this year, and the size of the RIN bank, and the fact that until the last couple of years, we've basically overproduced pretty much every year before that, that just doesn't seem to have the same impact on RIN prices as it does, or as it should, I guess. Again, right now we're seeing RIN prices decline and feedstock costs steady or a little bit higher. So if we don't get a reversal in RIN prices here, this will be something that I probably will spend a lot of time talking about. Until we get there, though, it still is, my standard response will still always be that feedstock costs really drive RIN values. And if you look at, again, if you look at the correlations, that tends to prove out. Over the past 2 weeks, D4 has dropped while SBO stays somewhat flat. Can you comment? What a great follow-up question. So yeah, that's it's a bit of a puzzle, and it may be that that I have gotten this completely wrong and just don't know it yet. What I will say is that if you sort of look historically, the feedstock costs have been the driver of prices. It doesn't mean that they always have to be, or that it can't change, or that I would ignore all evidence that relationship was changing. And this year does seem to be the year that we'll be able to sort of figure it out. And I've been sort of writing and talking about that for a little while, because of the initially it was sort of because of the shortfall, or the lower than expected capacity utilization implied for the renewable diesel industry. And then it has been because the final mandates weren't as, the growth in the final mandates relative to the growth in renewable diesel capacity wasn't quite the same. And so if we're going to overproduce, at some point, isn't that going to break the market? And now it's finally just down to, well, feedstock costs are steadier or higher, and RIN prices are moving lower. And again, we'll see whether this is sort of the beginning of the end of the feedstocks are the only thing that you have to worry. Feedstock costs are the primary driver of D4 prices, or if we're going to have to change our model and start to incorporate more supply and demand into our model for RIN prices. Why exactly it's happening right now, I don't have any great insight into that. But what I would say is that I do think that this will, again, provide some real insight into how this market works and how it's going to work going forward. And so even if I'm 180 degrees wrong on this, I'll still be happy, because we will have figured out kind of a little bit of something about how the market works, and how, at least in certain cases, feedstock costs aren't the main driver, and supply and demand does have an impact. All right, awesome questions this week. Thank you so much for all of those. Like I said, I won't see, or I won't be on here for 2 weeks. And so please enjoy Joao's presentation next week and ask him some good questions. And I will see you in the second week of September. I hope everybody has a wonderful end of summer holiday and enjoys the rest of August. And I will see you all in a couple weeks. Bye-bye.